Okay. Now in third scenario, you guys tell me what's the best. If it was scenario 3, we don't know. We don't know. These are the outcomes, uncertain outcomes. We don't know, right? But it was if it was scenario 3, which project we should have taken ideally? Ideally, which project in which there wouldn't have been any regret?
F.
It was F, and the return was 85. So return from the best decision, and if I opt this as well, there won't be any regret, right? So here, you see that the best was this, here the regret would be 0. Best here would be this, regret would always be 0. Because here you're not losing anything. Third scenario, this was the best. And if you opted, there's no regret, right? You see that?
Yeah.
You see the connection? In each of the scenario, we take the best, right? And what we couldn't get, the differential is the regret, right? Okay, the best here was 0 and here it was 20, losing 40 here. Best here was 0, but here you're losing. If you would choose this, you would lose 35. You would choose this, you would lose 30. Now in scenario 3, this is the best, but what if I choose this one? What's the regret?
75.
I'm losing 75 here. What about this? What about this? There's already a loss of 20. This already I'm losing 20 and the best was 85. So what I actually lose here? 105. 105. Now I told you what to calculate. Maximum regret in all the scenarios. And then choose the minimum of the maximum value. Here we were calculating maximum return, choosing maximum of the maximum, best of best. Here we calculated minimum return. So these are the words you remember and you would know how to apply it, how to calculate it, what to choose. Just focus on the words. Nobody would tell you that. Just focus on the words. Here we were calculating maximum return, choosing maximum of the maximum return. Here we're supposed to calculate the minimum return and all the options and take maximum of the minimum. Here we're going to calculate the maximum regret now. We have the regret table here, but we don't have the maximum regret. What's the maximum regret in D in all the scenarios? Yeah, because the idea is to minimize the regret. Now tell me in all three scenarios combined, tell me if I take D, what is the maximum regret? Which scenario? Just take that one out.
105.
105.
That's 105. What is the maximum regret here in E in all these scenario? If we choose E,
75.
what's the maximum regret in F in all the scenarios? We don't know whether
40.
it would be 1, 2, or 3. Uncertainty. Is uncertainty prevailing? I don't know. But I can take a better decision matching my risk aptitude based upon the decision rule. Maximax, maximini, minimax regret rule. So what is the maximum? 40. And now what to choose? Minimax regret rule. Minimum of the maximum regret. Choose the minimum. So which project to choose?
F.
It is F. It is F. In best, what we choose? The best. Which project we choose? E?
Yeah.
Maximax. Yes. Maximum and then choose the best. E. Here, what we choose? First calculate minimum and what is maximum?
F.
We choose
F.
F. And here as well. Here as well, we're choosing F. So which is better? Just tell me which is better. This is
F.
how we are analyzing. F is better. F is better. Why? Because here you're safe. Okay, you're safe. There are no losses in it, and also the opportunity cost is not that much. But definitely, if I would be a risk taker, why not earning 100? Why just taking 40 and 60, right? Why just taking 40 and 60? I want to earn 100. I would go with Sorry, I
Actually,
want to earn 120, so I would go with
120.
E. So it's
E.
all about the risk aptitude. So if there's a question in the exam, to figure out what's the risk aptitude, and then if an examiner asks you which project would be the best for the company, just figure out what's the risk aptitude of the manager, whether the manager is risk taker, risk averse, or risk neutral. So from the scenario and from the exhibit of the question, you will guess what's the risk aptitude. And also, if examiner asks you that whether to use expected value or VOI, is it a good idea to use expected value? You would see the risk aptitude again. What's the risk aptitude? Whether they're risk neutral or risk taker. If they are very defensive and risk taker, won't recommend expected value. And also, if there's no past data available, if there's no past record available and probabilities couldn't be estimated perfectly, then definitely expected value won't be very useful, because it is useful only when you have past data and and it's a recurring nature, and the decision has been undertaken quite a lot of time. Okay, then only expected value would be useful. So now one last thing here, decision tree. Okay, what's decision tree? And there's another sensitivity analysis and simulation. So a little bit about decision tree. What is the decision tree? So decision tree is nothing. If you just plot the same thing in the form of a tree, what is a decision tree all about? First of all, decision tree take relevant cost into account. So you are only going to take the relevant revenues incremental. It has to be a future cost. Any past sunk cost that has already been incurred, it won't be recovered back. Whether you change your decision or not, so it won't be relevant. Past and sunk cost won't be relevant. It has to be a future, and it only has to be the incremental. It won't include what you're currently earning, only the incremental cost and revenues would be considered. It won't account for any depreciation cost or any notional cost, because it has to be a cash flow in which there's cash inflow or outflow. Only those cost and revenues which is basically actually cash is being paid or cash is going to be received, you only account for that. So all of the notional cost, depreciation, that won't come under that. So first of all, based upon relevant costing, and then and the second thing is how to construct. First, you're going to construct a tree with all the options. There are two symbols which we are going to use. Okay, this square is used for a decision point, and a circle is going to be used for any decision that has got uncertainty in it, or it has uncertain outcomes. So outcomes, this is the outcome point, right? Outcome point, and there could be, to one decision there could be 3 outcomes, 3 to 4 outcomes. Just like in this decision, how many outcomes? How many outcomes? So how many outcomes would come out of the outcome point for each of the decision? How many outcomes are there? 3 outcomes.
3 out. Yes, ma'am.
And how many decision choices are there? So the thing coming out of that decision point are basically your decision options, would be your decision options, your choices. How many choices you have? You could either invest in D, E, and F. D, E, or F.
F.
D, E, or F. Okay. And and how to put it in this way. And the third important thing is, first you need to construct a tree, and then you're going to analyze. You're going to do a rollback analysis based upon which technique. It's used for a recurring event in which probabilities could be assigned, or in which you can uh, you have the past data, right? So which technique would be used?
Expected outcomes.
Expected values would be used. Remember how to calculate expected values: p times x, and then take a sum of all. So which option, if you have rollback analysis, did the rollback analysis, so whichever option would have, first you're going to, branches coming out of the outcome would have the probabilities, and it would have certain value. So two things you need: probabilities as well as the outcome value, in order to calculate the expected values. Say there are three. Okay, for example, if I consider that 50% probability it would be outcome 1, 25% probability it would be outcome 2, and 25% probability it would be outcome 3. So while you're making a tree, you would go, so which option you would do, that would have the highest expected value. Which decision you would choose, that would have the highest expected value. For example, here I get 70 expected value. Here I get 80, here I get 90. So which you choose, 1, alternative 2, or alternative 3?
3, ma'am.
3. Okay. So how I would calculate these expected values? So for each of the decision alternative, see, when I am making a tree, I would go from left to right. Right? But when I'm evaluating the decision and then coming to the point that which decision option I would choose, I would go from, while analyzing it, I would go from right to
Left.
left. Okay. Now, just this, I'm going to put it. You could choose D, you could choose E, and you could choose F, but the outcomes are not certain. Outcomes are not certain. So if outcomes are not certain, if D was a certain outcome, I knew for sure there would be a return of 1,000. So there won't be any outcome point. Outcome only comes when there is an uncertain outcome. When there is an uncertain outcome, for certain outcome, the decision would lead you to a certain profit or contribution. It won't have this outcome here. But here in this scenario, it was an uncertain outcome. I say it was an uncertain outcome. In D as well, so I would start with this outcome point. And how many outcomes were there?
3.
Could be 1, could be 2, or could be scenario 3. In 1, if I choose 1, return could be 100, could be 90, and it could be a loss of 20. And E also was uncertain. Three scenarios were there. In one scenario, I could earn 80, 120, and 10. See how I put it? It's not that difficult. Just know the concept. The square root for decision, circle for outcome. Things coming out of your decision point definitely would be your decision options, right? What you take here. You take here in payoff table your decisions, and here you take in rows, you take your outcomes, right? So start with a decision point.
Yes.
And then work out for the uncertainty. I don't know whether demand would be scenario 1, 2, or 3. There's uncertainty. So the profit based upon uncertainty would be different in each scenario. I don't know which scenario it would be, right? And also for F, I don't know which scenario would it be and which profit would it be. It could be 60, could be 85, and it could be 85. So I told you, third thing, rollback analysis. While you're constructing tree, you're going from right, left to right. And now when you're coming to a decision, you will go from
Right to left.
to left. And on what basis you would take your decision? Based upon expected values. So for that, you don't only need, you need two things, probabilities as well as your outcomes, so that you can take P times outcomes and take sum, right? So if I take an example that the probability of outcome one is, for example, it's 25, outcome two is also 25, and outcome three is 50%, right? Again, here it would be the same. And here as well, it would be the same. Can you do the rollback analysis for me? Can you calculate summation
Yes, ma'am.
px for D, summation px, which would be expected values for E, and summation of p times x for f? And can you tell me which option to choose, D, E, or F? Because we have already done this question based upon maximax, maximini, and regret. Okay? But if probabilities were given, we could have done the same question using expected values as well for a risk neutral person, right? We could have done the same thing in the form of payoff table, and also we could have done it in the form of a decision tree. Usually decision tree makes the visual understanding better, and it's easier to analyze your options rather than a payoff, assessing it in the form of a payoff table, because at times you have multi-stage problems, complex scenarios, a lot of uncertainty, a lot of uncertain outcomes. So in that scenario, it's better to use the decision tree. So decision tree, because at times you have to take multiple decisions in order, you may be taking series of 2-3 decisions before coming to a final decision. Is it possible? Or there could be a lot of uncertain outcomes, or it could be a multi-stage decision problem. So for a lot of uncertain outcomes, for multi-stages in which the final decision comes from after taking series of decisions. This was easy, but it could go ahead. Uncertainty could arise and it could reach here, could reach here, could reach here. Yeah, there could be uncertainty related to selling price, related to cost. So it could make a bigger tree. And at times there are decisions, you are not taking only the final decision. There are square points in the middle of the tree as well. Okay. So when it's a square, that means whenever it's a square, that means you either have to choose this or this. You can't take both. But when it's a square, and that means you have to ultimately take a sum of all, because these are outcomes. You don't know, outcome could be this, this, this. So what you are deciding based upon expected value. So what you would be calculating, expected return. But if it's something in the middle of the tree, it's like this. Don't try to add it up. It would be wrong, because it's a decision point. And these are alternatives. So alternative, you need to choose one. You need to choose one, whether you will launch a product or not.
One.
You can do both, right? But here, if you're launching a product, you said demand could be 1,000, could be 2,000, could be 3,000. Here you would be calculating expected values. Why? Because the branches coming out of the outcome point are basically your uncertain outcomes. And for uncertain outcomes, how to do the rollback analysis, you take P times X and then add it up. Right?
Yes,
Right.
ma'am.
Okay, now do the rollback analysis and come to the decision.
Ma'am, F.
Decision F. Okay, what's the expected values for D?
37.5.
37.5. 5. How I calculated it? 100 into 0.25
which is 25.
plus 90 into 0.25, and then it was
22.5.
negative, right?
Yes,
Okay,
ma'am.
so
Negative
that
10.
would be subtracted. 20 into 0.5. Okay, that's how you're going to do it. And this 80 into 0.25 plus
25
120 into 0.25 plus 10 into
0.25.
0.5.
10
Okay.
into
55.
5.
Okay. Here
55.
it is 55. Here it is 37.5. Now the third one. Third one.
78.75.
Oh. 2.25 plus 85 into 0.5. Which one to take? This is, what is expected?
78.75.
78.75.
75.
Okay. Now tell me, is it outcome point or decision point?
Outcome point.
No, this is
Decision.
decision points. So that means you could either take D, E or F. Don't try to add it
F.
up now. Now choose the best here. Which is the best? F.
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 Which is the best? F. Okay, let me take you to a question here in the practice platform now. You could quickly do that for me. So, a leisure company owns a number of large health and fitness resorts, but one is suffering from declining sales and is predicting to make a loss in the next year. As a result, management have identified a number of possible actions. So, actions could be their decisions they might take, definitely, based upon expected values. Okay, and it would be good if it would be a recurring one. Okay, otherwise it's based on expected values, the reliability and taking the best decision would be difficult in that case. But here it could be a one-off one, right? But don't get into that thing. Just oh, yeah, sure, sure. You haven't gone. Oh god, Juma prayers today. Go quickly. Okay. Shut down the resort and sell off the assets. One option. Shut down and sell. Second, undertake a major upgrade to facilities. Okay. Okay, maybe improve the facilities at a cost of 4.5 million. Oh, sir. Okay. Undertake a minor upgrade to facilities costing 2 million. So, which one to take? The upgrades are predicted to have variable results and the probability of good results after a major upgrade. You see that you already have the decision tree constructed. Good thing in your exam that a decision tree, you don't need to, previously you used to make the decision tree all by yourself, but the examiner either tested in section C, a decision tree would already be there, just you would need to do the rollback analysis and coming to the final decision. So your work gets easy this way. So already a decision tree is there. Three options we had: shut down and sell, major upgrade or minor upgrade. Shut down and sell, we clearly had return of 5.75. Shut down the result and said there wasn't any cost associated with that decision. Shut down and sell had no cost associated, because we just shut down and sell and the return was this. This was a certain outcome, right? So that's why you don't see any outcome point and branches coming out of that, right? But major and minor upgrade, if we opt for a major upgrade, results could be good, results could be bad. So probability of good results after a major upgrade is 0.8. You're not given the probability of poor result, but that's understandable. What would be the probability for the poor result here?
20%.
20%, because overall it has to be 1 or 100%. Whereas the probability of good result after a minor upgrade is 0.7. Now again, you're not given the result, probability for poor result. So if good is 0.7, what would be poor?
30%.
30%. Very good. Now you have the cost as well. Okay, first take the return. Okay, probabilities, assign probabilities, do the expected values. Okay, and from expected values you need to deduct this cost as well. Is it because you have to base your decision on the relevant cost? These are the incremental profits, incremental revenues or contribution coming out, and you also have to account for this cost as well, because this is incremental cost. If I'm going to go for major upgrade, I will have to incur a cost of 4.5 million. And also when you get expected values for minor upgrade, do minus this 2 million as well, and then you will get your answer. How to do that? Do the rollback
Ma'am, answer
analysis.
is
It's already there.
minor
Which
upgrade.
one to take? So I told you 0.8 into 11 plus 0.2 into 7.5. What you get here is
10.3.
10.3. And then here as well, it was 9 million into probability of good result was 7. And worst, you could get 6 million and probability is 0.3. And take
3%.
a sum of all, because you're calculating what? Expected values. Once you have the expected values, now it's final evaluation, and now you have to decide, choose whether shut down and sell, whether go for major upgrade or minor upgrade. So you need to count for this cost as well. From expected values, it was certain outcomes. So just compare, write is as it is, 5.75, no additional cost. Major upgrade, you have expected value of this and you have to deduct 4.5 as well. So what is the final return here? 5.8. And here as well, 8.1, 8.1 minus 2, it is 6.1. Now which one to choose? Now see,
Minor upgrade.
is it an outcome point, a circle or a square here?
Square decision point.
So that means now you have to choose. Now you have to choose here. Now no expected values. Here you have to choose. So which is better? I would choose minor upgrade, because that has got the expected return. That option should be chosen. Okay. Now my logo. We're going to do a question, my logo, and in this question we will read two more concepts as well. Okay. So Miloco runs a cafeteria situated on the ground floor of a large corporate office block. Quickly tell me, if Milo adopts the Maximini approach, which daily supply level would be chosen? Maximini, first calculate the
Minimum.
minimum return. Minimum here is 1170, minimum here is 980, minimum here is 810, minimum here is 740.
740.
You choose.
1170.
Which option to choose? Supply level to choose. So these
450
are
hunches.
the outcomes. These are the demand level is the outcome, not under your control. Decision is under your control or not?
Yeah.
Outcomes are not
Yes, ma'am.
uncontrollable, but decision is what is in your hands, right? So taking into account the risk aptitude of the manager as well and applying the decision rule, Maximini is a risk averse or risk taker?
Risk averse.
Risk averse. He want to take the best of the best of the worst. Very good. Okay.
Worse.
Next, minimax regret rule. Quickly make a regret table. If it's 450 demand level, which you choose? The best one is
1170.
if the demand level is 450, which you choose and which regret would be 0, 1170. But if I choose instead of 1170, if I choose 980, what's the regret?
190.
190. So here write down 450, 620, 775 and 960 and start calculating. The maximum is 1170. What if I choose supply of 775 and get only 810? What is the regret here? 360. So start doing it with me. 1170 minus 740. What I'm losing is 430. So one is done. This one is done. Now focus on 620. This one. What is the best here I could get? In which the return regret would be 0. So the return from the
1612.
best option is 1612 and return from the option current I choose is 1612. So the regret here is, if I take 620 as well, so regret here would be 0. But what if I choose this? What would be the regret?
442.
1612, I choose 1170. Regret would be 442. Now here, 1395. I could have earned this, but if I choose 775, I would only get 1395. So the regret here is 217.
7.
Now here,
322.
322. Now, what if the demand level is 775? The best would be, in which the regret would be 0, would be 775, supply of 775. So I have to take a
205.
decision. Here the regret would be
205.
0. But what if I choose this instead? What is the regret?
2015.
249
Minus
on the 960.
What?
845. 845.
What are we doing?
So I could have earned 2015, but the option I chose gives a return of 1170, which was supply of 450. So it is 845 is what I lose here. And what about this? So best was 205. What if I get 1612? What is the differential?
403.
Differential would be the regret. Here
Regret.
it's none. Here is
725.
isn't it 230?
230.
230. See,
1290.
the best was
Hmm,
2015. I took as 1785. So what I lose here is
230.
230. Now last
230.
one.
Yes, ma'am.
What if the demand was 960? The best I could have taken the supply of 960, right? And the return best was
496.
2496. So if I also take
Yes, ma'am.
2496, regret here is 0. But what if I take 775 supply instead? I lose some money here.
481.
What I lose is 481.
1.
And what if I take 620, supply of 620? I could have earned 2496 by taking supply of 960, but I took 620. So what I lose, but I take, yeah, 620. So what I lose here is, the return is 1612, right? And what I lose is 88.
884.
Very good. So I could have, by choosing 9 supply of 960, I could have earned 2496, but unfortunately I chose a supply of 450. So what I lost, and the return was
1326.
1170, and what I lost is 1326.
6.
Now tell me, you have calculated, now you will calculate it in each of this option vertically. You will calculate what? Maximum. Just like here you calculate minimum and choose maximum of that, and maximax as well, you calculate maximum return and choose maximum of that. So here you have to calculate in each of this option, you have to calculate the maximum regret in all the outcomes, because you don't know the outcomes as yet. So what is in this option, would be the maximum regret in all the outcomes? 1326.
1326.
26.
In 620, what would be the maximum regret here is 8
800.
and
84.
84, right? What would be the
Yes, ma'am.
maximum regret here is 480.
1.
What would be the maximum regret here? Would be 430.
30.
30.
Now, need to choose minimum of the maximum regret. What's the minimum regret?
430. 960 lunches.
430. I would choose 960 lunches because here the regret is lowest and my aim is to minimize the
Max.
Risk.
regret. Yeah, regret because I'm a sore loser who keeps sulking about what he couldn't have. So better not to lose in 1326 by choosing 450 and get a heart attack. Got it?
Yeah.
Okay. Which of the following statement are true if Milo chooses to use expected values to assist in his decision making regarding the number of lunches? It has to be a recurring one, repeating many times over, right? And what other? If Milo chooses expected values, so Milo would be considered to be taking a defensive and conservative approach. Would it be defensive or risk neutral?
Neutral.
Neutral. Defensive is risk taker, right? So it's not a right statement, and you need to select the right statement out or the true statement out. It could be more than one. See this thing here. Expected values will ignore any variability which could occur across the range of possible outcomes. Yeah, one thing I couldn't tell you because of short of time is that the expected value, whatever is the expected value, is the average figure. But what would be the variability of the actual outcome? For that, what you need to know, for that, what you need to calculate is the standard deviation. Standard deviation actually tells you what, and then you calculate the coefficient of variation, and then you calculate the standard error. That actually gives you what is the risk in that, whether investment A is risky or investment B. For that, you don't base, because here both had an expected value of 10. Yeah. So now what to take? Then we would quantify the risk. Then we would take which is more riskier. For that, for variability, expected value doesn't, it just gives you an average figure, most expected outcome. It doesn't tell you, it ignores the variability. For that, you need to calculate the standard deviation. Actually, we have a technical article written over here, and I did a video in which I actually did all the calculations on how to calculate the standard deviation. First, you calculate expected values, then this is the outcome minus expected values. You calculate this figure, and then you take a square of that, and then whatever comes, you multiply it with probabilities, this, and then you take sum of all in order to get variance. And how to calculate standard deviation? Standard deviation is square root of variance. Just take a square of this value. You would get this standard deviation. So standard deviation tells you the risk, and then coefficient of variation, how you calculate the coefficient of variation, standard deviation divided by expected return. You have the formulas. I have the formulas in the PPT as well. In the videos, I discussed it in detail. So this was a wrong statement. This is the right statement, that expected values ignores any variability. So variability, what factor accounts for variability is standard deviation. So this is the right statement. You need to pick the true statement out. Expected value will not take into account